We're going to look a bit more closely now at this mining tax. How is it going to work? Who's going to pay it? And will it raise the money the government expects it will? Joining me here in the Canberra studio, Stephen Koukoulas from Market Economics, and from Perth, John Murray from BDO Australia. Thanks both for joining us. Stephen, first to you. On this revenue assumption, $10.6 billion over the first 3 years, do you think that's a safe assumption?
Look, it's the best we can go on at the moment. Treasury have spent a lot of time and effort working exactly how much will be raised by the MRRT.
With the industry, we should point out.
With the industry, correct. And the industry are happy to pay that amount of money. That's the background of all this.
Well, some of them are, some of them aren't.
But since the MyEFO numbers were produced late in November, the Australian dollar's been a bit stronger, and that does have a dampening effect on profits. And in fact, the prices of some iron ore and coal, which are the benchmark of the MRRT, have actually fallen a bit. So look, it's a little too early to say that the 10.6 is going to be an overestimate, but if you were just to say where are the risks, given the currency move, given the underlying price move of these raw materials, you'd say there's a little bit of a downside bias to some of these numbers.
But to what extent is hard to know, given the fluctuations?
Really hard to tell, because the dollar could fall tomorrow, or the price of iron ore could bounce tomorrow. But you'd say that there's a potential of a couple of $100 million over the 3 years of the forward estimates. Not more than that just yet, but it's just a little bit of a downside risk.
But in the context of a fairly narrow surplus the government's looking at, every dollar counts. John Murray, do you agree with that sort of assessment of how much this tax is going to raise?
I'd tackle it slightly differently. If we go back to the Treasurer's comments around October, November, he indicated that 90% of the MRRT revenue was going to come from the mature miners. And when we've done our modelling on the mature miners, based on the publicly available information, and I accept that that's a qualification, and just looking at the iron ore side, our numbers were saying that there's a good chance very small or no tax will be paid by the mature miners. So if you put those two thoughts together, that the government is expecting 90% to come from the mature miners, and based on our numbers, we're saying very little will be raised from the mature miners, I think the government's got a problem.
Well, just to drill down on that, you're saying the mature miners, i.e. BHP Billiton, Rio Tinto, Xstrata, you don't think in the first few years or several years they are going to be paying any of this tax. Explain to us why that is. Yeah,
the two key shelters that the companies can access, one's called the starting base allowance. And the starting base allowance conceptually is trying to recognise that the mature miners had up and running projects, had expended considerable sums of money in getting these world-class projects up and running. And so there's a concession that's been built in which in effect values the resource as at 1 May 2010. The second point I'd make is when you look at the price of iron ore at or around that time, it was relatively high. And what we've had since then is a dramatic fall around September, October in the iron ore price, and I concede that it's gone back up again. But when you listen to Rio and listen to the commentators about where they're predicting the iron ore price to go, it's going to drop. So what we have is 1 May valuation done at relatively high prices, and that sets a series of deductions going over the life of the project or the life of the particular assets. That's been calculated by reference to a high price. If the revenue is then subsequently somewhat lower than that, you're going to have high deductions and lower revenue, and that to me doesn't sound like you're going to get much money out of the tax.
So just to be clear on that, John Murray, you're saying we're not going to see anywhere near the $10.6 billion raised in the first few years?
Correct.
All right. Stephen Koukoulas, just on that factor that the big companies can offset what they've spent over the last 20 or so years in developing these mines, that is going to eat into the revenue, isn't it?
I think that was taken account by the Treasury because those numbers are not secret to them. And in fact, that's been well publicised. And in fact, as I understand it, the companies gave Treasury and Department of Finance a lot of this information when they were calculating these numbers. So in a sense, nothing much. The numbers that
so you don't see that as a bigger factor.
It would be hard unless there's a little loophole there that the accountants are frantically trying to jump through. I think that those numbers would have been known by Treasury. The discussion would have been very transparent.
Okay.
So my guess it'll be something other than that which causes the revenue to be slightly different.
Well, my next question to you both, and Stephen, first to you, who's going to pay this? Is it going to be those big three, BHP, Rio, Xstrata, or is it going to be some of the smaller or mid-tier miners? I know Clive Palmer has said today he's not going to be paying much, if any, of this. Who's going to pay it?
Sure. Well, it's predominantly the big miners. They're the ones that are making the super profits, if we can use that term again. They're the ones that are going to be having to pay the amount over and above the normal company tax rate because they are receiving prices for the stuff that they're digging out of the ground that are phenomenal at the moment. Compared with, not just the last couple of years, but compared with 5 or 10 years ago, the price of iron ore, the price of most grades of coal is 4, 5, 6, 7 times greater than it was. They're making incredible profits. And
what about Fortescue? I mean, Andrew Forrest's going to challenge this in the High Court. Will he have a significant bill?
Hard to tell yet. The intimate company details are a little hard to judge, but over the course of the next few years, maybe not just the next 3 years of the forward estimates, I think we've got to have a look beyond that and look to some of the medium-term background of this tax, is that it's designed to actually redistribute some of this very, very high super profits that are going to certain industries and certain geographical areas of the country, and they need to be redistributed to the less well industries and the poorer segments of the economy as well.
Yeah, John Murray, what do you think? Clients lining up worried about this? Do they understand it, and do they know who's going to pay it and who's not?
I think it's a real issue, and if you go back and look at the submission that we lodged with Treasury on the second draft release of the legislation, we highlighted our concerns that we thought the mature miners may not pay much, if any, MRRT in the early stages, and it's been documented publicly that some juniors are going to, or emerging companies, are going to be paying it in the first year. And we highlighted this as an inequity. We suggested a remedy to that, but the government has not picked up on the suggestions that we've made, and in fact other organisations have been highlighting the issue as well. And AMEC, for example, suggested 3 alternative means by which the emerging companies might be assisted in dealing with an inequity.
But John Murray, the Treasurer, talks quite often about the huge investment pipeline in mining, $450-odd billion, despite the fact this tax is now a reality. It's going to come in. Is it scaring off investment? I mean, admittedly, he's talking about the whole mining industry. This tax is only for coal and iron ore. What do you think? Is it going to worry investment?
It's a good question. I start to get a little bit nervous when I read today, I think it was today, that BHP said, given the softening of the Chinese market, they'll be reviewing their projects. Now, one of the problems we're going to have is we'll never actually know that a project did not proceed because of the mining tax. It can be explained in other means, in other ways, but my concern is when you start to see strong companies like BHP reassessing their investment portfolio, and it coincides with the introduction of the tax, it's not too hard to join 2 dots together to come up with a line.
Yeah, what do you think, Stephen?
Oh, look, the pipeline's still there. The mining tax, the way that this is being structured, it is only the really profitable industries and mines that are going to be paying this tax. And it would be fanciful, I think, to assume that mining projects are going to be derailed by the tax simply because the cost of extracting those raw materials in Australia is so low relative to the current global price. So if we were to see the global price drop by 30, 40, 50%. Sure, the profitability of these companies would be significantly lowered, but the investment in these projects would still go ahead. Australia is still a very cheap place to extract the high-quality coal, the high-quality iron ore, and it would take a calamitous fall in the price rather than this mining tax that's going to stop this mining investment. And even though China's slowing down a bit, I don't think we're going to be getting anywhere near the level of the prices that we saw for these raw materials from 5 or 10 years ago.
So just to sum up then, Stephen Koukoulas, you don't think it's going to have a huge dent on the pipeline of investment in mining. You think it's going to be the big miners who will pay this,
Yep.
and the government will come close to the sort of revenue that it's expecting.
It'll be sort of close, and don't forget that the money is not just being squirreled away. The money is going into cutting company taxes elsewhere. It's to build some infrastructure and increases in superannuation. So there's an offsetting stimulus elsewhere in this redistribution, if we can call it that. So whatever downside, and there might be a marginal downside to mining, as we've just discussed, will be more or less offset by some upside in the non-mining parts of the economy, which is exactly the intent of the tax.
And John Murray, finally to you, you doubt that the tax is going to raise what the government expects. However, you still think it is going to scare off some investment, even though we may never know exactly what it has scared off.
Look, it'll be one factor that companies looking to open up new mines will need to consider in working out their return on investment. But I certainly agree that the revenue take, based on the assumptions that we've taken, the revenue take will be nothing like the government is predicting. And our big concern is the government's now writing cheques that it can't cash. It's making promises based on revenue, higher revenues that we have grave doubts will not be raised.
All right, John Murray from BDO Australia, Stephen Koukoulas from Market Economics. Good to talk to you both. Get some analysis on this. Thanks for that.
Thank you.